According to the trading charts, both the European currency and the British pound extended losses as part of their downward correction ahead of the upcoming US jobs data. Yesterday's statistics on US weekly jobless claims were ignored by market participants. The reading met analysts' forecasts. Eurozone retail sales fell in August, pointing to weakness in consumer demand. On an annual basis, the indicator dropped even below expectations. As a result, the euro slid. As for today's macroeconomic calendar, the focus of investors will be on US non-farm payrolls. Friday's report from the US Labor Department is expected to show an addition of 250,000 jobs in September, in a slowdown from 315,000 reported for August. If the indicator is in line with estimates, the Fed will no longer need to act aggressively. In this case, the US Central Bank may stop its interest hikes as early as this year and start cutting them next year when inflation shows signs of cooling. However, Fed officials continue to stress the need to keep raising interest rates and tightening monetary policy until inflation falls back to its 2% target. If non-farm payrolls show an increase of 250,000 jobs or below, and the US unemployment rate ticks up, the greenback will most likely come under pressure from weaker expectations of further rate hikes. Thus, risky assets will gain value. Alternatively, if US non-farm payrolls increase above consensus expectations, the dollar will continue its bullish run, thus dragging stock indices further down. In this case, market participants will shift their focus to inflation data to be released in the middle of this month. Today, traders may also take notice of data on retail sales and industrial production in Germany, as well as the European Leaders Summit. However, these reports will hardly have severe impact on the quotes dynamic. And now let's take a look at the 1-hour Euro-American dollar chart. From a technical point of view, it is worth focusing on the level of 0.9809. Which acts as intermediate resistance. A false breakout at this mark will create a sell signal, thus pulling the euro down to 0.9761 and 0.9725. At the level of 0.9725, I recommend going long on rebound. Long positions at 0.9761 can be considered only amid a false breakout. If the price consolidates above 0.9809 and tests it from the top down, the European currency may edge up to 0.9841 and probably 0.9879. At the level of 0.9841, it will be possible to go short amid the false breakout. Short positions on a rebound will be relevant at 0.9879. At the moment, it is quite difficult to predict the pace movement following the release of US jobs data. Therefore, it is not worth entering the market at the nearest levels. In case of a sharp drop in the euro, it would be a wise decision to go long on a rebound at 0.9687 and 0.9646. In the event of a steep rise, one should not rush to open short positions on a rebound, but try to sell the pair at 0.9912 or 0.9948. Speaking of the British pound, the 1-hour trading chart shows that the situation is similar. If the price forms a false breakout at 1.1187, a sell signal will be generated. Bears will probably make every effort to break below 1.1116. However, this task will be challenging without data on the US labor market. This breakout and test from above will create an additional sell signal. In this case, the pound sterling will dip to 1.1029 and 1.0955. Traders may go long on a rebound only at the levels of 1.0876 and 1.0955, with a view to catching an intraday correction of 50-60 pips. If bulls gain control of 1.1116 or the price settles above 1.1187 and tests it from the top down ahead of US jobs data, the volume of long positions will increase. Thus, the British pound will enter an upward correction to 1.1255 and 1.1313. Short positions on a rebound following statistics from the United States can be opened only at 1.1313 or 1.1371. In this situation, one can count on an intraday correction of 40-50 pips. Best of luck.